Welcome to Breaking News to Trading Moves. Welcome to the debate. Imagine a highly trained professional, moving $200 million in contracts on a given morning. They are heavily scrutinized.
Right, with a very strict mandate.
Exactly. Yet, if they lose money in the morning session, the probability of them taking completely irrational risks in the afternoon spikes by over 30%. Why does that happen?
Well, it is because the human brain is entirely unequipped for the probabilistic environment of financial markets.
Putting a human mind into a market is like asking someone to navigate a dark room while wearing night vision goggles that, randomly invert the colors. The very tools we evolved to survive actually trick us here.
That is a harsh reality to confront. The cognitive machinery that keeps us alive in the physical world often becomes our greatest liability when we are staring at numbers fluctuating on a screen.
Which brings us to our central inquiry today. How should market participants manage the inevitable psychological challenges of decision-making under uncertainty?
We are looking at behavioral finance literature, neuroeconomics, and empirical data on investor habits.
Right. My position is that structural discipline and fixed risk parameters are required to bypass human cognitive flaws. Because our psychology is inherently flawed when exposed to probabilities, we must build absolute systematic guardrails.
And I contend that emotions should not be neutralized. They need to be integrated as critical market feedback.
So you just want to rely on feelings?
Not exactly. Attempting to achieve absolute emotional neutrality is a trap. True cognitive optimization requires decoding our feelings as vital data points, rather than trying to pretend they do not exist.
Let me elaborate on why structure and systematization are the only reliable defense mechanisms we have. When we look at the empirical data on investor habits, we see predictable, repetitive cognitive failures.
Like the disposition effect.
Exactly, the disposition effect. This is a behavioral pattern where individuals reliably sell their winning positions far too early, and they hold their losing positions entirely too long.
Right. Driven by loss aversion.
Loss aversion and regret avoidance. Human beings possess a powerful biological aversion to accepting a certain loss. We would rather hold on to a deteriorating situation than close the mental account and admit we were wrong.
Just hoping it turns around.
Right. Because our brains are hardwired this way, relying on willpower or in-the-moment judgment is a losing proposition. Willpower fails under pressure.
So your solution is just to take the human out of it entirely?
The only reliable solution is rigid systematization, yes. We must utilize self-nudges like predefined stop-loss orders. We enforce hard limits on daily activity and establish structured setups to guarantee execution quality.
I understand the appeal of a purely mechanical approach. It sounds clean, but I reject the premise that human emotion can or should be bypassed.
Why? The data clearly shows it ruins execution.
Drawing on neuroeconomics and behavioral science, it becomes undeniably clear that emotions do not exist randomly. They serve a distinct, evolutionary, and cognitive purpose.
Sure, out in the woods, maybe not in the markets.
Even in the markets, feelings of pride, boredom, or pain are not just noise to be tuned out. They should be treated as precise data points indicating cognitive blind spots.
But how is feeling pain a useful data point?
If you feel sudden elation, that is a physiological alert telling you that you are minimizing risk. If you feel pain or anxiety, it is an alert that you are operating with incomplete awareness or trying to force a decision.
I am not so sure about that. Elite professionals do not
suppress these feelings. They translate them. By treating emotions as a diagnostic tool, you gain a level of real-time market awareness that a rigid, unthinking checklist simply cannot provide.
Let's actually look at the mechanics of the disposition effect and regret avoidance to understand why suppression through rules is so necessary. The financial cost of these cognitive biases is staggering.
You are referring to the return drag.
Yes. Research demonstrates that the disposition effect costs the average market participant 3.2% to 5.7% in returns. That is a massive destruction of capital.
It is, yeah.
And it isn't just retail participants making these errors. Studies analyzing Treasury bond futures traders at the Chicago Board of Trade reveal that even highly trained professionals fall victim to this.
Right, the afternoon risk spike.
Exactly. These are the traders I mentioned at the top of the show. They were found to take far more risk in the afternoon if they had experienced morning losses.
Wow.
Specifically, there was a 31% probability of taking above average risk after morning losses, compared to a 27% probability after morning gains. This is the classic get-even-itis mechanism.
I come at it from a different way. The data you cite is accurate, but the conclusion you draw misses the underlying mechanism.
How so? It is the desperate desire to break even just to avoid closing the day in the domain of losses. To me, this proves the absolute necessity of fixed risk and structural guardrails.
Let's talk about the exact physiological reason why get-evenitis happens. Realizing a financial loss creates a literal, measurable pain response in the brain.
Right.
The neural circuitry that processes physical injury overlaps with the circuitry that processes financial loss. So when that morning loss occurs, the brain is in agony.
Which is why you need a hard rule that cuts off trading for the day when a certain loss threshold is met.
The afternoon spike in risk-taking is simply a dopamine-seeking survival loop. The brain wants to make the pain stop, and the only way it knows how is to try and win the money back.
Exactly. That completely supports my point.
But structural rules alone fail precisely because they ignore that acute psychological pain. When you tell someone to just use a stop loss or stop trading for the day, you are asking them to willingly inflict emotional pain on themselves and sit with it.
And they have to do that to survive?
But they do not do it. That is why they move the stop loss down. That is why they log into a secondary account and keep going. To truly overcome the disposition effect, you must develop psychological capacity, not just mechanical rules.
I am skeptical that you can just logic your way out of that pain.
Consider the data on outperforming mutual funds. These top-tier funds utilize momentum. They hold their winners and let them run. Doing that requires an immense capacity for what behavioral scientists call hedonic framing.
Explain how hedonic framing applies here. What does that actually look like in practice?
Hedonic framing is the mental process of altering how you categorize a loss or a gain to manage the psychological impact.
So mental gymnastics.
In plain English, it means tricking your brain into seeing a $500 loss not as a personal failure, but as a subscription fee you pay to access the market.
That is a very optimistic spin.
An outperforming professional does not just coldly hit a mechanical stop loss. They actively reframe the loss as a necessary business expense on the path toward a broader progress goal. They integrate the pain.
So they are effectively disarming the physiological response before it happens.
Exactly. And conversely, to hold a winning position that is fluctuating in value, they must manage the fear of giving back profits. A rigid rule cannot force you to endure the anxiety of watching a position pull back 20% before it goes higher.
You talk about sitting with the pain of a loss. But what happens when there is no pain, just pure agonizing boredom?
Oh, that is a trap for sure.
That is where emotional integration completely falls apart and leads to our next problem, overtrading. Much of overtrading isn't born from dramatic fear or greed, but from boredom and a total lack of session structure.
That is incredibly common. The brain craves action.
When the market is slow, individuals often start forcing setups just to feel productive. They refresh charts, they switch to smaller time frames, and eventually they take an entry that would never qualify under standard conditions.
Because they cannot sit still.
Precisely. And this is where strict routines become paramount. Checking higher time frames first, marking key levels before the session begins, and defining valid setups in advance completely filters out impulsive entries.
I think you are placing too much faith in the routine.
I liken this to an airplane's pre-flight checklist. The checklist exists precisely because the pilot's subjective feelings about the safety of the plane are utterly irrelevant to the actual mechanics of the aircraft.
Okay, I see where you are going with this.
A pilot doesn't ask themselves how they feel about the flaps. They verify the flaps are locked. In the same way, a trader's feeling of boredom is irrelevant to the actual mechanics of the market.
I am sorry, but I just don't buy that. Let me tell you why the pre-flight checklist analogy breaks down completely in this context.
Go ahead.
An airplane is a closed, predictable mechanical system. If you perform X action, the machine will reliably produce Y result.
And a market is different?
A financial market is an open, probabilistic environment driven by collective human behavior. Boredom is not a mechanical failure of the brain. It is a highly evolved physiological response to a low stimulation environment.
But that response is exactly what ruins execution.
When the market is slow and choppy, dopamine levels drop, and the brain actively seeks stimulation. If a person simply tries to ignore the emotion and force themselves to stare at a rigid checklist, the biological drive for dopamine will eventually win out.
They just have to stick to the list.
They will subconsciously bypass the checklist, they will rationalize a subpar setup, and they will take the trade anyway.
So how does acknowledging the boredom actually prevent the forced trade? If the dopamine drive is that strong, staring at your own boredom doesn't magically stop you from clicking the mouse?
It does, if you translate the emotion into a market read. Elite professionals feel the exact same boredom as amateurs.
Right. The physiological response is identical.
But instead of fighting it or suppressing it with a mechanical rule, they analyze it. They say, I am feeling extremely bored right now. Why? Because the market is not providing clear, high-probability setups.
So you are saying the boredom itself is the signal.
Exactly. Their boredom is actually accurate feedback about current market conditions. Amateurs treat boredom as a problem to be solved with a trade. Professionals treat boredom as the market telling them there is no edge here today.
They just accept it.
They accept the slow market as a condition to be respected. The boredom becomes a clear signal to protect capital, rather than a nuisance to be suppressed.
I see why you think that, but let me give you a different perspective. Relying on your feelings to interpret market conditions introduces an unacceptable level of subjectivity.
How is it subjective if it is a physiological fact?
If I start using my boredom to decide whether the market is slow, I am entirely at the mercy of my own neurochemistry. Maybe I am just tired. Maybe I had too much coffee.
Well, you have to know your baseline.
Professional execution requires treating losses and inactivity merely as business expenses. Emotional reactions to drawdowns or to slow periods lead directly to abandoning the system.
But can anyone truly respond to a severe financial threat mechanically?
They have to. Every trading methodology experiences drawdowns. The difference between success and failure is not avoiding the drawdown, but responding to it mechanically.
Humans are not machines.
If you allow yourself to dwell on the resentment or the pain of a loss, you create emotional spikes. Success means normalizing losses to reach a state of calm execution. In this state, your identity is completely detached from the outcome of any single event.
You are describing a robot.
You predefine your risk, you execute the setup, and whatever happens, happens. Emotional neutrality is the ultimate goal because it preserves clarity and discipline. The less you feel, the better you execute.
That is a compelling argument, but have you considered that emotional neutrality is largely a neurobiological myth?
A myth?
Yes. Humans are incapable of true emotional neutrality when real stakes are involved. The pursuit of this myth actually makes participants far more vulnerable to the very biases you want to avoid.
I disagree. Rules create safety.
Profitable individuals do not suppress these feelings. They leverage them. Let's look at the other side of the spectrum, away from pain and boredom. Let's talk about pride and elation.
Oh, the winning streaks.
Exactly. When someone experiences a winning streak, they feel a massive buildup of pride. They start to perceive themselves as being perfectly aligned with the market.
Which is incredibly dangerous.
An amateur buys into that narrative, polarizes their emotional state, feels invincible, and subsequently forces low-quality setups because they literally stop perceiving risk.
Which is exactly why I argue for fixed maximum daily trade limits and strict risk parameters. If the rules are hard-coded, the amateur's pride cannot destroy their account.
Assuming they follow them.
The system restrains them. When they hit 3 winning trades, the system locks them out, regardless of how invincible they feel.
But the system only restrains them if they follow it. And when an individual is blinded by suppressed, unexamined pride, they will eventually break their own rules.
They shouldn't be able to bypass a software lock.
They will disable the software lock. They will increase their position size because they are certain the next trade is a winner. A professional approaches the pride entirely differently.
How so?
The moment they feel that elation, that positive emotion radiating from a winning streak, they use it as an immediate, blaring warning sign of complacency.
So they turn a positive feeling into a negative warning?
They do not suppress the pride, they flag it. They ask themselves grounding questions. What did I miss? Where am I taking unnecessary risks? Am I perceiving myself above the market right now?
I am not convinced by that line of reasoning because it implies that we can consistently and reliably psychoanalyze ourselves in real time under pressure.
It takes practice.
You are describing a level of psychological mastery that takes decades to achieve, if it is achievable at all for the average person. Think about the physiological reality of a sudden market event.
The flash crashes.
Yes, a rapid drop in price triggers immediate visceral panic. During that response, the amygdala essentially hijacks the brain's executive function.
The fight-or-flight response.
Exactly. Blood physically moves away from the prefrontal cortex, the logical reasoning part of the brain, and goes to the survival centers. Cognitive processing capacity narrows dramatically.
That is true.
In that moment of pure panic, you cannot rationally ask yourself what this fear is telling you about your incomplete awareness. You are just watching capital evaporate.
Well, you still need automation.
Right. You need a predetermined stop-loss order resting on a remote server to execute automatically. The structure saves you when the psychology predictably fails.
I agree that server-side stop losses and physical guardrails are absolutely necessary tools. No one is arguing against using a seatbelt.
Then we agree on the necessity of rules.
But they are secondary to the internal framework. Let's examine what happens immediately after that automated stop loss is triggered. The system executed flawlessly. The capital is protected from catastrophic ruin.
The system did its job.
Yes, but the individual is now sitting at their desk, feeling the acute pain of the loss, feeling shame or resentment or anger. If their entire operational philosophy is based on bypassing emotions, they have absolutely no tools to process that psychological aftermath.
They just move on to the next trade.
They cannot just move on. They are sitting with raw, unexamined adrenaline. They will likely fall right back into revenge trading the very next day just to soothe their ego.
Only if they lack discipline.
To break the cycle, they must utilize the resentment and the pain as feedback. They must process the experience, review their past successes to lift themselves back to baseline, and return to a balanced state of thinking. Only in that balanced state can they objectively assess the market tomorrow.
So you are suggesting that the structural rules are merely the safety net, but the actual sustainable edge comes from emotional integration.
Exactly. The rules keep you alive, but the emotional awareness makes you profitable. Unprofitable participants constantly try to control, remove, or suppress their emotions.
They want to be logical.
They view negative feelings as a weakness to be hidden and positive feelings as a validation of their genius. Profitable participants use both ends of the emotional spectrum as flashing indicators that they have an incomplete awareness.
A diagnostic tool.
Yes, elation means you are blind to the risks. Pain means you are blind to the opportunities. By actively interrogating those emotions rather than hiding behind a checklist, you return yourself to the center.
It is a thorough framework, but I maintain that the foundation must remain structural. If we review the core of this discussion, my position remains that predetermined rules, strict daily routines, and fixed risk parameters offer the strongest, most reliable defense against our innate cognitive biases.
I hear you.
We know the disposition effect exists. We know that dopamine loops exist. We know that humans are terribly equipped to handle probabilistic environments.
We definitely agree on that.
Therefore, removing the burden of choice through systematization protects capital far more consistently than attempting to interpret every psychological fluctuation.
And I maintain that cognitive biases cannot be sustainably managed by hiding behind rules. Rules get broken when pressure is applied.
If they let it happen.
These biases are best managed by developing acute emotional awareness. When you use your feelings, be it the urge to overtrade out of boredom or the hesitation to cut a loss out of regret, as a precise diagnostic tool, you gain profound insight into your own market perception. You stop fighting your humanity and you start utilizing it.
Despite our different methodologies, there is a clear area of convergence here. We both entirely agree that unexamined emotional reactions, whether that manifests as sheer panic during a sudden drawdown or reckless overconfidence after a string of wins, are immensely destructive to capital.
100%.
We also agree that objective decision-making in probabilistic environments does not happen naturally. It requires active, relentless effort to maintain.
Absolutely. Whether you choose to manage that vulnerability by building rigid external walls or by developing internal emotional mastery, doing nothing is the only guaranteed path to failure.
Which brings us back to where we started. The challenge of decision-making under uncertainty remains one of the most compelling puzzles in human behavior.
It really does.
Unlike the engineer calculating the exact stress tolerances of a steel bridge, those operating in financial markets must continuously navigate a landscape where the primary variable is human fallibility itself. The behavioral finance literature offers so much more to explore regarding how our cognition operates when probabilities are completely unknown and stakes are incredibly high.
The material we've discussed today merely scratches the surface of how our neurobiology interacts with risk.
Indeed. We will leave it to the listener to decide which framework best suits their own psychological temperament. Do you build the checklist, or do you decode the emotion? That is a question every market participant must ultimately answer for themselves. Thank you for joining us on Breaking News to Trading Moves.